The business community has expressed reservations over the move by the central bank to increase the central bank rate, CBR, which signals an increase in the lending rates by commercial banks. This month, the central bank announced an increase in the CBR by 1 percentage point to 8.5%, a move that traders insist will worsen their woes given the prevailing tough economic environment.
So it's very unfortunate that the Bank of Uganda went further to increase the CBR, because logically they are assuming that we have money. But the fact is, Ugandans, we are very broke. Business-wise, we are totally suffering. Comrades are closing their shops, properties being confiscated. We are failing even to meet our loan obligations. And we are competing with foreigners. Chinese, they can access a loan at 2%. Kenyans, they're accessing loans at 8%, 10%. And we are competing. And now we are in the East African common market. So we think that the Bank of Uganda is not fair.
The CBR rate is an indicative rate announced by the central bank upon which commercial banks base their interest rates, and its increase is a signal for commercial banks to increase lending rates. However, with challenging economic fundamentals such as a weakening currency and rising inflation, experts assert that the central bank is right in raising the CBR, which in essence is an inflation control tool with other economic stability benefits.
My thoughts, central bank was justified and is justified in increasing the CBR because it protects the economy from accelerated effects, for example, of currency depreciation. If the economy was let to run free, we could get into a situation of hyperinflation. But by tightening a monetary policy through increasing the central bank rate, it kind of slows down. If there was a depreciation of the currency or the currency was weakening very fast, tightening the monetary policy and increasing the CBR reduces that.
Experts are, however, not oblivious to the economic impact this carries with itself, but insist that it's a move that had to be taken.
It's a double-edged sword, obviously, because in increasing the CBR, the ripple effects or the resultant effects are that interest rates in the economy would also increase, and that would hurt borrowers, for example, because then they would have to borrow more expensively, and a lot of the businesses and generally the economy is still in recovery from the lockdown or the effects of the lockdown.
Pundits also note that controlling inflation, which is the central bank's main concern, should go beyond just using monetary policy tools like raising the CBR rate, given other external and internal factors driving prices currently.
But remember that Uganda's inflation is cost-driven, and by that I mean that the inflation is being caused by increases in prices of, say, fuel, increases in prices of basic commodities on the back of global political events like the Ukraine-Russia war that's affecting wheat, which is the main component of food, and also, for example, local increases in prices of grain because of prolonged drought across the country.
This position is shared by the business community, who maintain that policy implementers should look elsewhere but not increase the cost of money as a solution to the prevailing economic woes.
And we are petitioning Minister of Finance to reconsider that position. We just have deficit in supply. Now, like for petrol, there is a deficit and there is high demand. And then for food or agric products, the problem is the prolonged drought. So the reason by the I feel to understand how they came up with such an idea. We can handle this inflation when we boost our agriculture product capacity.
Given where the economy sits today, policymakers and implementers like the central bank are faced with a tough balancing act where they have to act using the tools they have at their disposal, but at the same time protect businesses, which takes much more than monetary tools like the CBR.